This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 4 deals with the structure of businesses, business change, the value chain, and the McKinsey 7S model. First of all, why is the structure of a business in a paper which is called Performance Management? And it's there because the way a business is structured is going to determine the way it is managed. It's going to determine to whom various people report. It is going to determine how different divisions or departments are perhaps going to be judged and managed in a way that is going to maximize the overall company performance. The first structure we deal with here is what's called the functional structure. This is the simplest structure, and most businesses, as soon as you begin to get any size at all, begin to evolve into this sort of a structure. And basically you have it arranged because each function has got a whole department. So you have the finance function, it has the finance department, the manufacturing department, the sales department, and so on. Advantages of this structure, well, you tend to get considerable economies of scale. All the financial transactions go through one department. They gain considerable expertise there. You can afford to pay a well-qualified person to be the head of each of these departments, and so on. Secondly, the people within each department feel fairly comfortable. You're dealing with colleagues who are from similar backgrounds, and you talk the same language. Why, therefore, would we ever depart from this functional structure? And really that happens as the business begins to get larger and larger and larger, and really two things begin to happen. First of all, the heads of each of the department, once you are maybe, say, in manufacturing, looking after perhaps 2,000 employees in a very large factory, you are an important person, and sometimes the power goes to your head, and you can become a bit uncooperative with people in other departments. So you could almost imagine a scenario where somebody from sales comes through to the manufacturing department, says, we have this fantastic order coming in, we want you to perhaps interrupt, if you could, your production schedule, so that we can accommodate the order coming from this very important customer. And the manufacturing director says no, because the manufacturing director sees if the production line is stopped and set up for the new order, there are going to be all sorts of adverse variances that are going to have to be explained away. So the manufacturing director or manager begins looking after his or her own interests, rather than seeing that the manufacturing department is one of the many departments in the organization, and it is organizational success which matters. Secondly, as businesses grow, there is inevitably a degree of diversification. Now, by this I don't mean going into radically different businesses, but you would have sales in Europe and sales in North America and perhaps sales in Asia. But the markets faced in those three areas are very different. There'll be different competitors, different pricing, different ways of advertising. They may require slightly different products. There may be different legal frameworks that they have to comply with as well. And if you try to ram all of this together, just having one sales department, one manufacturing department, one finance department, it's probably not going to work very well. You're probably going to get more success really coming from specialization. Your North American division, the people there know what the North American market wants, knows the laws and regulations governing the products which they're producing, knows the competition, and gets to know their customers very well. Similarly in the European and the Asian market. So once the business grows, it can then become divisionalized, essentially by geography. Well, that's one of the ways in which it can happen. So there we have. It's two divisions: finance, manufacturing, R&D, sales, in each of these divisions, and so on. Alternatively, it could be divisionalized by major product line. So we used to have one very large chemical company in the UK, and essentially it made two types of product. One was paint, and the other was agricultural chemicals. And really there was nothing in common between the manufacturing, the customers, the suppliers, and it made no sense at all to bring them together. Once you have divisionalized, it also opens up the way to allow you to compare how each of the divisions is going. It gives you almost a benchmark, an internal benchmark, and you can almost have a competitive environment going on to see which of the divisions is making best use for its capital and so on. The problems with divisionalized structures is, first of all, you can get a certain duplication of effort. You maybe have now 2 finance departments, 2 IT departments, and so on. Secondly, it requires a degree of coordination. You don't want the North American division and the European division both perhaps trying to win a contract from an international client. You have to make sure they're not competing against each other. And sometimes if the divisions are based kind of on product, that Division A makes the components and Division B assembles those components and sends them all on, so the components are going from Division A to Division B, then it gives you transfer pricing problems, which is a whole area that we're going to have to look at later on. But divisional structures for large organizations are almost universal. The next structure we have is a matrix structure. This is very common in contract work. So we could have projects or contracts, contract A, contract B, contract C, going down the side here. Each of these contracts or projects would have a project manager, and you need a mix of skills to run that contract or project. So here we have a person who has been assigned to project B or contract B, and who is going to be reporting to the contract manager in B. But this person also have a kind of technical discipline. This is a quality control person, and will have to report to the quality control manager. The claimed disadvantage of the matrix structure is that it is going to put this person perhaps under quite a bit of competing pressure sometimes. And some people say that's not fair. Let's say that Project B was going behind time. What the Project B manager could say to this person, they could say, well, we need to speed up. I would like you to drop some of the quality control tests. But the quality control manager says, no, you mustn't drop those tests. We want to make sure that the project is completed safely and at the specification and so on. So here we have, in a way, two managers putting competing pressure onto this poor person here. And some management theory says it's wrong to have two bosses shouting at you. I think one boss shouting at you is quite enough. My own view is that this doesn't create these type of conflicts. I think even if it wasn't set out in a matrix structure, that you rarely just are reporting to one person. You have got a number of different responsibilities within organizations. And I think in a way, depicting it on a matrix structure actually brings it out into the open. If you were this person here, this junior person, really the wrong way for you to make the decision is to listen to the boss who shouts louder, or listen to the boss who is more intimidating. That is no way to make a proper decision. And here you are the most junior person out of these three. Why is it being forced on you to make the decision as to whether or not you should let the project go late, or whether or not you should leave out some of the quality controls? Could you not say to these people, like, look, I'm reporting to you, I'm reporting to you. You are the two most senior people here. You are the managers. Why don't you two cooperate? Why don't you two get together and discuss what needs to be done? So it should enforce cooperation. What we want is a win-win. We want the project to be done on time, and we want the project to be done safely and to the right quality standards. And it might be that these two more skilled, more experienced people know a way in which that could be done, perhaps by dropping one or two of the tests or postponing them to do them later and so on. And then when they've got to the solution, they can tell this quality control person what to do. Disadvantages in this, the main disadvantage probably is this person might not really know who the main boss is. If you can't get agreement between these two here, which one should they listen to? But again, I'm not sure that this is something which is actually caused by being more realistic about the structure of the responsibilities within the organization. Finally, on structures, a modern structure is a so-called network or virtual organization. And really what the company does here is it outsources as much as it can. And all it keeps is its core company, and all it retains is its core activities, what it does that it is almost uniquely good at. And it will subcontract out here. It could subcontract, for example, its accounting department. It could subcontract people to look after its IT. It will almost certainly subcontract its legal services, subcontract the human resources and the like. It will even often subcontract manufacturing. So a supplier here is not just a supplier of components. It's potentially a supplier which actually manufactures the finished goods. And what this company does, it will have perhaps a website. The customers come on the website. The company gets in touch with its subcontracting manufacturers, and the goods will actually go directly from the supplier to the customers. So this company is kind of sitting in the middle of a web, organizing stuff. What it would mean is if you looked at the company's financial statements, it could have a very large turnover, but really quite a small balance sheet because it will have had no real manufacturing facilities at all. Everything is going to be subcontracted out. This is, to some extent, quite fashionable at the moment. The idea really at the moment is you concentrate on what you're really good at, where you can uniquely add value, where you are uniquely better than your competitors. In other words, you have competitive advantage. And you get rid of all the other stuff, because you're not making money out of, recording your financial accounts, running your IT, running your human resources. You're not even making money out of manufacturing. You might be making money out of design. And it's your clever designs that you get a really well set up manufacturer to make very efficiently, perhaps in a low cost area of the world. That's the best way to make profits. One of the trends we just mentioned very quickly here, really starting in the 90s and the 2000s here, is a move from the tall narrow into the wide flat. This movement here really was something which took place, as I say, around the 1990s and the 2000s. Companies had deliberate delayering and flattening strategies because they were convinced that the tall, narrow structure, which is really quite an old-fashioned bureaucratic structure, was not good at improving their performance. What drove this change? Well, a couple of things. First of all, there was increasing cost pressure. It was in the 1990s and 2000s that many manufacturers in the Far East began becoming really very important, and they had very low cost bases. And companies began thinking about these people here, these middle managers, thinking, what are these people actually doing? You have got senior managers who are managers, who are managing senior supervisors, who are managing supervisors, who are managing assistant supervisors, and all of this kind of supervision which was going on it's probably a luxury they couldn't afford, and was probably something that wasn't necessary. So one thing that drove this was the cost reduction. The second thing which drove it, really in the 1990s and 2000s, technology began to move much faster. Whereas back, if you go back even to the 80s, 70s, a company would make one product and it would really keep making that product for several years. Now, not many companies are not going to have a product launch at least every year. And we need to also keep up to date with technological changes. And what was happening here was that it was terribly slow to react. So perhaps the person at the bottom, a new graduate coming in with new information about IT, how important Twitter or Facebook is, these kind of social networks were in marketing, tells this person, tells them, etc. And it goes up here from manager to manager to manager, each jump slowing it down, and each jump probably distorting the message very slightly, and then it would have to kind of come down here. And by the time it went up and went down, the people at the top, etc., would be really making decisions which may have been based on distorted information, but which were far too slow. With this wide, flat organization here, then the distance between top and bottom is much less. They're much more egalitarian. You would be much more likely to actually see the chief executive officer in an organization with only 4 layers than you would be in an organization with 20 layers. So an essential way of improving performance was to keep up to date, to get quick communication, and to be flexible, to react to the market, to react what competitors are doing, and so on. So moving from tall, narrow to wide, flat is essentially what many businesses have tried very hard to do. There are certain implications of that. On the tall, narrow, if each manager was looking after only 2 people here, you could nearly duplicate their work. You didn't have to be a very good manager, very good delegator. These people didn't actually have to be very good at their jobs because they're going to be checked up on very closely. But if you're looking after, say, 20 people or 10 people here, you cannot re-perform 20 people's work. You have to be a better manager to delegate properly to these people. And these people probably have to be better employees because they're going to be working more on their own. They might enjoy it, but they also need better training and also better access to information. Again, it tended to be that information was often kind of conserved at the top of organizations who made the decisions, which then kind of trickled down to the organizations. If you are delegating to more and more people, then you have to match that delegation with a change in who has access to information, because you need information, the right information, to make decisions. Decentralization and centralization kind of goes with the kind of structures we've got here, but this is to do with how much power you put down. If I went back to this, the structure here is not telling us whether this person has got kind of authority to buy something for only $100, or has got authority maybe to sign off on an order for $10,000. So there's a slight difference between the shape of the organization and how much power trickles down. And decentralization really looks at how much power trickles down. And again, this can be very, very important to improve the profits and performance of an organization. look at all the good things that come from decentralisation. First of all, top managers have got time to concentrate on the top decision. You don't want the top manager's time to be taken up with deciding what sort of coffee machine they should get, when they also have to decide, should I open in Europe or not? So it clears the desk, if you like, leaves top managers with just top decisions, gets rid of the more basic decisions to people further on down the organisation. Second, you're probably going to get better decisions. They're going to be faster. The person in South America can react quickly to marketing forces in South America, perhaps to put on a promotional campaign to deal with some local competition. It's probably going to be decentralisation will also probably delegate to functional experts. I come from an accounting background. There's little point in asking me to make decisions if I was the CEO. Little point in asking me to make decisions about where the advertising should be taking place. Really, the person who knows about advertising is the advertising manager. So let the advertising manager make the better decision. And again, geographically, the person who knows about the Brazilian market, let that person who is an expert in that market make those decisions. It motivates staff. People get a huge job satisfaction from being put in charge of stuff, and then solving little problems. And then if it goes well, and they can be praised for making the right decision and running the department well, it's hugely motivational. Good people will not stay if all they have to do is to do what they're told, rather than be given responsibility. Finally, training and assessment of staff. If you don't allow anyone to make decisions, who do you know is going to be good at making decisions? Who are you going to promote? The disadvantage, the major disadvantage, is a possible poor coordination or dysfunctional decision-making, where one division makes a decision which is going to harm another division, and which overall means the group loses out. The worst example I ever had of this was a company which had grown quite quickly by acquisition. Many people within the company didn't quite know the name of all the group companies. And we had one company based in the UK, another company based in America, part of the same group, and they began bidding for the same contract. And they didn't know they were part of the same group, and they just bid against each other, bringing the price down and so on. So you need some coordination, and we'll see when we get on to transfer pricing that wrong transfer prices is one area where it needs to be perhaps coordinated from the top. And now we come on to business process change. The first slide we don't need to spend very long on. It's really saying there are kind of 3 degrees of change, 3 amounts of kind of seriousness of change. First of all, you can have automation. That's just doing by computer what used to be done manually. And we've seen this in wages and salaries. We've seen it in looking after the receivables ledger and so on. We've seen it in perhaps placing orders. So for many years, in a supermarket, they scan the goods as you leave the supermarket. The inventory records are updated. And when the inventory falls to reorder level, then you can alert managers, or perhaps the computer system itself is going to place an order to replenish those goods. Rationalization is going a little bit further. It's removing bottlenecks, removing inefficiencies which are there. And I will say here, let's take this place order one here. We thought that was going pretty well. Automatically keeping track of the stock, and when it goes down, automatically sending out an order to the supplier. But if you think about it, that's not fantastic, because the order will arrive with the supplier somewhat out of the blue. It'll rather surprise the supplier that suddenly an order has arrived, And the supplier might have to start manufacturing stock, or at the very least the supplier will have to start putting the goods into a lorry and arranging it to be sent to the supermarket. Why don't we get the supplier to monitor the inventory at the supermarket? So if we have here the supplier monitor stock. So all the suppliers are given access to the supermarket's inventory system. They keep an eye on their inventory, and when they see it coming down, they could anticipate, gosh, in 2 days it's going to be out of stock. I will begin now thinking about manufacturing goods or arranging delivery so that when it goes down to the order level, effectively the inventory is instantly replenished. So there we have, by changing who was doing the work, who was doing the monitoring, we were probably going to get much more efficient inventory management. And finally, this business process reengineering. This is a very radical change. There is no hard and fast difference here. But the change, the common example which is talked about in terms of business process reengineering was Ford Motor Company. And it's Ford Motor Company, their headquarters in Detroit, Michigan. And there they had a very large manufacturing plant, and they had a lot of people in what they call their accounts payable. And accounts payable would be looking after, we'll have basically they would have purchase orders, and then we would have a goods received note, which said it can be attached there, then they would wait, and then in would come the invoice, and when the invoice came in, they would make sure the prices were correct, they would make sure the invoice agreed with the goods received note, they make sure the goods received note agreed with the order, and so on. There are lots of matching and kind of checking. When the invoice came in, then you would credit it to the payables ledger and so on. And at one stage, there were about 400 people employed in the accounts payable department. And then someone had a bright idea. They said, why do we need invoices? And they said to the suppliers, don't send us invoices. They said, we know we've got the goods, we know we've ordered the goods, and 30 days, and we know we want to spend on those goods, what we're going to pay for those goods, we know the agreed purchase price. 30 days after we get the goods, we'll pay you. And we don't need an invoice. And effectively what this did was to reduce the number of people employed there from 400 down to about 40. Simply, it got rid of all this kind of paper chasing and matching and so on. Now, you couldn't do that in every economy. You couldn't do it in Europe because we had all sorts of VAT implications and so on. But it worked fine for them. How do we find how best to change? What are the redesign patterns, as they're called here? And the first one, really the most radical here, this business process reengineering. We've suggested here you've got a zero-based approach. And really what a zero-based approach is saying, knowing what we know now, knowing how large we are, how many deliveries we get, how many deliveries out we get, how many countries we operate in, if we were to start again, almost have our life over again, knowing where we're going to end up, how would I organize my business? Where would I put the factory? Where would I put the warehouses? Would I have several factories in different countries, or would I have it all centralized and so on? So a zero-based approach is really is almost a vision of the promised land. It's almost saying, in a perfect world, how would I like this business to be organized? That doesn't mean you can easily change from the perhaps a bit of a shambles you're in now to this kind of perfect structure, but it gives you a direction to go in. Secondly, simplification. Eliminate duplication and redundant steps. So that was, I suppose, what Ford Motor Company did. It said, do we really need to be getting invoices, looking up the selling prices, making sure the invoices and so on are at the right amounts? Do I need to move goods between various departments and so on? Because every time you move goods around or send information around, really there are two people being involved, the sender and the receiver. Third, value-added analysis. Is there any way we could change the product that would make it cheaper to manufacture, but which wouldn't hurt the final product and what customers think of it? And one of the non-value-adding activities here is inventory. So just-in-time inventory. We as consumers don't really care very much about whether or not raw materials or finished goods are in a warehouse. What we want is quick delivery. And the company holding vast amounts of inventory is not necessarily something which we're willing to pay for. And finally, gaps and disconnects. We're really looking for poor coordination here. Would perhaps supplying another department with a little bit more information, would that make us run rather more efficiently? The McKinsey 7S model says that when you are considering business structures and indeed process change, there are 7 things to be considered. The ones in blue, the 3 at the top here, are known as the hard S's. The yellow ones, and indeed the one in the middle, the shared values, are known as the soft S's. And it says, so they say, that the hard S's are relatively easy to pin down, to write down, to capture, if you like, whereas the soft S's are rather more difficult to actually define. I don't think you need to worry about it too much. Just take it as a bit of a checklist. You have to think, for good performance, do I have the structure of the company correct? Should we perhaps move to divisional structure? You have to think about systems. This could be IT systems, it could be accounting systems. Do the systems produce an efficiency? Do they carry out the sort of processing that we actually require? The style is really the style of management. If you have an organization where really there's not very much change going on, not very much development in technology, then the style of management that can be adopted, almost the culture that can be adopted, is one where the manager is really quite strict. You just tell people, just get on with that. It's not going to change for the next 2 years. Just keep your head down and do it. Whereas in an organization where there is a lot of change in competition, a lot of changes in technology, the style probably has to be much more participative, because you have to ask other people in the organization who may be experts, how do you think we could best compete with this product that a competitor is bringing out? Staff. How many staff? What sort of training are we going to provide for these people? Skills. What skills do they need? Strategy. What's our overall strategy? Is it going to be one where we're going to go cost leadership? Is it one where we're going to be differentiation? And not every business has got a free choice there. If you're a small business, then it's probably inappropriate to try for a strategy which is cost leader based, because small businesses find it very hard to get costs down. And if you can't get your costs down and you can't get your selling price up because you're selling ordinary products, your performance is going to be miserable, making this horrid little profit. Whereas differentiation might be the right strategy for a small business. You can raise your selling price, you can focus your efforts on a specialist niche of the market, and you can probably do much better. And then in the middle, hardest of all perhaps to define, is the shared values. Almost what is the core culture of the organization? Is it properly based on committed to giving really good customer service? And you know, when you go into different shops, for example, or perhaps approach different computer manufacturers, that they've got quite different shared values. If you go into an Apple store and you have all of these people in kind of T-shirts willing to give you expert advice and so on there, these people are convinced that Apple is the best company in the world, its hardware and software is best, and so on. They really believe that. And this could be very important in performance management. If your employees don't really believe that you're a very good company, it's very hard to motivate them. They are not going to be as convinced that selling something to you is going to be the right thing to do. The value chain. This should be familiar to you from P3 and perhaps other areas here. Again, very, very quickly, what's it about? And what Porter's value chain sets out are basically all the activities which are carried on in the business. And the two sets, there's along the bottom here, there's what's called a primary. Primary activities is inbound logistics. This is physically how you get the goods really to the production stage. So it could be the supplier which sends them to you. And then you have to decide, am I going to keep them in a warehouse? Are they going to go straight onto the production line and so on? It could be that you go out and collect the goods and so on. There are all sorts of different ways in which you get goods in, and you're looking for the most appropriate and efficient way of doing it. Operations, how are we going to organize operations? 1 factory, 2 factories, 3 factories? What degree of automation do you require within that? Outbound logistics. Are we going to have, for example, our own delivery vehicles, or are we going to get a logistics company to do it? Are we going to have one warehouse centrally, or are we going to have several warehouses over the country or throughout the world? Are we going to send stuff by rail or air? What's the best way of getting the goods from production to the customer? Then we have marketing and sales. How are we going to ensure that customers, first of all, know about us, or potential customers know about us? How do they know about the new products and so on? How are we going to keep in touch with these people? Service. Service can be an important revenue earning activity. Service is anything which is sold after the main product, and this could be installation of machinery, it could be training of the operatives, it could be maintenance, and it could be supplying consumables. And all of these can be profit-earning opportunities. But still we have to decide if we are going to offer repairs and maintenance to people who've bought one of our machines. Are we going to have our own engineering staff going out? Or are we going to subcontract this to perhaps a national or international firm who has got lots of kind of local people scattered throughout the world? The 4 going across the top here, these are usually called the support activities. These are more like fixed overhead type activities. We have to think of the firm infrastructure. Where is the head office going to be? How are we going to structure IT, accounting, and so on? Do we want separate accounting departments for separate divisions, or is it all going to be centralized? Technology development is basically research and development, developing new products and new processes. Human resource management, which is really going to be recruiting people, training people, motivating people, appraising people, and motivating, I think I said motivating people. How are we going to ensure we have the right people, properly trained, properly motivated, to perform the work that we need? And finally, procurement. Procurement is the act of placing orders. I've never been quite sure why procurement is regarded as a kind of support activity, whereas sales and marketing, which is kind of the other side of it, is regarded as a primary activity, but no matter. How are we going to find suppliers, really, to supply the raw materials? And then we're going to place the orders and so on. All of these activities which are carried on are aimed at producing a profit or a margin. And what the value chain is really saying is we have to understand, we almost have to do a bit of almost meditation going on here. We have to say, why is it customers come to us and are willing to pay us good money for what we do? What is it that gives us the right to earn profits? Is it that we produce goods much more cheaply than they could do because we're operating on a global scale? Is it that we're producing very clever goods where we put a lot of research and development into it and they couldn't possibly copy that? Is it that they pay us good money because they don't want to do what we're doing, because maybe what we're doing is risky, and they're willing to pay, a revenue to us, which is going to be above the cost, allowing us to produce a profit, because we remove from them a lot of bother, a lot of risk, and so on. But whatever it is that keeps customers coming back to us, this is a key to good performance. And whatever change we are putting through in the organization, we must be careful not to destroy what customers really value. So if customers come to us, perhaps because we produce goods of fantastic quality, let's say the customer is something like Boeing, making aircraft. We're making a component of the aircraft. There's very little tolerance of components which are of inferior quality when you're making an aircraft. Fairly obviously, if we were to try to cut costs, perhaps in our operations in here, by not having quite the right quality control, then Boeing is going to stop coming to us. In some other situations, people come to us because the quality isn't quite so important, but they want a really low cost per unit. And again, if we were to perhaps put orders for more expensive raw materials, and these more expensive raw materials eventually get incorporated into the operations, and we lose our ability to sell goods at a really low price, then those people won't come to us. So in one case, quality was important. In another case, it was low cost, which was important. In other cases, it might be you always have in your warehouse a vast range of products, and you can always supply the product needed by your customer. But whatever it is that the customer treasures, the customer values, you must be sure not to mess that up. This is the secret of good performance, that you can keep pleasing your customers.